On April 27, Prime Minister Mark Carney announced Canada's first ever sovereign wealth fund, Canada Strong Fund, $25 billion to invest in infrastructure, energy, and manufacturing, modeled after Norway's legendary $2 trillion oil fund. Sounds amazing, right? Except there's one massive problem. Norway's fund is built on oil wealth and savings. Canada's fund is built on borrowed money while we're already running a $67 billion deficit and sitting on $1.2 trillion in federal debt. So is this a visionary investment in Canada's future or the biggest debt trap in our history? Welcome back to KP Money Talks, and today we're breaking down Canada's new sovereign wealth fund, what it actually is, how it differs from every other sovereign wealth fund in the world, and whether Conservative leader Pierre Poilievre is right when he calls it a sovereign debt fund. This could reshape Canadian infrastructure for generations, or it could bankrupt us. Let's figure out which. Hit the subscribe button for honest Canadian economic analysis. Let's dive in. Let me explain what Prime Minister Carney announced on April 27, 2026. The Canada Strong Fund is Canada's first national sovereign wealth fund, designed to invest in nation-building projects alongside private sector capital. Initial endowment is $25 billion over 3 years, cash basis. Investment focus is infrastructure, energy, critical minerals, advanced manufacturing, and agriculture. Here's what makes this fund different from traditional sovereign wealth funds. 1. Retail investment product. Any Canadian can invest their own money directly into the fund. This is extremely rare. Most sovereign wealth funds globally are government only. Number 2. Arm's length management. The fund will be a crown corporation with an independent CEO and board of directors, separate from direct political control. Number 3. Commercial returns focus. The fund must generate market rate returns like a private investment fund, not just pursue policy objectives. Number 5. Indigenous equity partnerships. Indigenous communities will be full partners with equity stake in projects, not just consulted. Carney positioned this as a fundamentally different from historical nation-building projects like the Canadian Pacific Railway, which displaced Indigenous people and enriched only corporate corporations. This time, he says the returns flow to all Canadians. Prime Minister Carney explicitly compared this to Norway's government pension fund Global, the world's largest sovereign wealth fund at over $2 trillion. But here's the problem. They're fundamentally different. Norway's sovereign wealth fund has, funded by oil and gas revenues, only spends the investment returns, never the principal, can only invest outside Norway, build up over decades from surplus revenue, and Norway runs budget surpluses. Whereas Canada Strong Fund, as funded by borrowed money, will invest domestically in Canadian projects. Canada is running a $67 billion deficit for FY 2026. Federal debt is $1.2 trillion, and Canada has no surplus to invest. Bernardo Bortolotti from NYU's Transition Investment Lab argues that borrowing to invest in a sovereign wealth fund can make sense as long as the fund's return exceeds the interest cost on the debt. If Canada borrows a 4% interest but the fund generated 7% returns, that's a 3% net gain, but that's a big if. And it assumes the fund will be managed professionally, not politically. Conservative leader Pierre Poilievre has been absolutely scathing about the Canada Strong Fund, and his critique deserves serious consideration. Poilievre's core argument is that countries need to have wealth for a wealth fund, but all Canada has is debt. Putting another $25 billion on the national credit card to pad a liberal slush fund will not change anything. Here are his keynotes. Number 1. The money already exists. The investment exists. It comes from our country. It just can't get a return in our country, Olivier argued. His point: Canadian pension funds and private capital already want to invest in infrastructure, but can't because of regulatory barriers, slow approvals, and political uncertainty. Number two, regulatory barriers, not capital shortage. Projects in Canada struggle not because there is no money available, but because environmental assessments take years, permits are delayed, and political interference kills projects. For example, the Trans Mountain Pipeline took 12 years from proposal to completion and required a federal government buyout because private investors couldn't navigate the regulatory maze. Number three, the business case problem. If a project has a business case, why would the government need to fund it? If it doesn't have a business case, why would the government want to fund it? Olivier asked. This is a fundamental question. Profitable projects attract private capital. Unprofitable projects shouldn't be built with the taxpayer money just because the government wants them. Number four, borrowing to subsidize what government can't approve. Borrowing yet another $25 billion out of the economy to subsidize projects that government still cannot figure out how to approve will only cost hardworking Canadians, Olivier said. His argument is that fix the approval process first, then private capital will flow to good projects naturally. To be fair, let's examine the Liberal government's counter-argument and why they think this one makes sense. Number one, diversification argument. Carney argues that Canada's former strengths built on close ties to the United States have become its weakness due to US tariffs and trade uncertainty. The fund aims to diversify Canada's economy away from US dependence by investing in domestic capital. The crowding in argument. The government argues the fund will crowd in private capital, meaning every government dollar will leverage 3 to 4 times private investment. If $25 in public money attracts $75 to $100 billion in private capital, that's $100 to $125 billion in total infrastructure investment that wouldn't have happened otherwise. Market failure argument. Some infrastructure projects have strong social returns but weak commercial returns, creating a market failure. Private investors won't fund them even though they benefit the country. For example, rural broadband, northern infrastructure, indigenous community development. The fund could bridge this gap by accepting lower returns on strategically important projects. The comparison to existing programs. Canada already has entities like the Canada Infrastructure Bank, Business Development Bank, Export Development Canada, and Canada Growth Fund, doing similar things. The Canada Strong Fund consolidates and scales these efforts under professional investment management. Bill C-5, the approval speed up. Carney passed legislation, Bill C-5, last June to fast-track approvals for nation-building projects. The Major Projects Office has already referred 15 projects and is developing 6 transformative strategies in nuclear, LNG, critical minerals, and transportation. Now let's be honest about the risks here, because they're substantial. Risk 1. Political interference. Despite claims of arm's-length management, there is enormous pressure to use the fund for political priorities rather than commercial return. Will the fund invest in most profitable projects or the projects in swing riding before an election? Risk 2. Retail investor losses. Opening the fund to retail Canadian investors is unprecedented and risky. Most people don't have spare cash to invest, and those who do might not understand the risks. Risk 3. Debt compounding. If the fund generates 5% returns, but Canada is borrowing at 4%, that's only 1% margin. If interest rates rise or the fund underperforms, we're losing money while piling on debt. Risk 4. Picking winners and losers. Governments have a terrible track record of picking winning companies and projects. The fund could become a political slush fund for favored industries and connected insiders. Risk 5. Crowding out private capital. Instead of crowding in private investment, the fund could crowd it out by competing with private investors and distorting markets. The bottom line is that Canada's first sovereign wealth fund is either a visionary investment in our future or a $25 billion debt-fueled scam, depending on the execution. The fund differs fundamentally from Norway's model. It's built on borrowed money, not surplus wealth. Conservatives argue we need regulatory reform, not more government spending. Liberals argue the fund will leverage private capital and diversify our economy. The truth? We won't know for years whether this was brilliant or disastrous. If this helped you understand what's really happening, hit that like button and subscribe, and I'll see you in the next one.